All right, so let's get back to Chapter 5. We're going to probably finish Chapter 5 early on Friday. And in Chapter 5, we're dealing with merchandising operations. And right now, we're dealing with definitional issues, or at least some issues that make a merchandising company different from a service entity. We said a merchandising company would be different because they're selling goods and services rather than providing services. When you are selling a product rather than providing a service, you wind up with a cost of goods sold. This is one of the key differences, and that's what we're looking at now. Some of the primary differences with the financial statements of the merchandiser versus the service entity. So when you have a merchandise company, revenue is now called sales revenue, and you also have to have a cost of goods sold. What's the cost of goods sold? That's how much you had to pay to acquire the inventory that you're selling. So Verizon pays Apple $100 for an iPhone. They sell it to you for $300. Their selling price is $300. Their cost of goods sold is $100. It's what they pay to acquire the merchandise. And then, of course, the operating expenses would be the same. So the first difference is the cost of goods sold. And, of course, as we go on to tell you, we would generally expect this to be the largest expense, or one of the most significant expenses for a merchandising entity. And again, the gross profit is calculated by sales minus cost of goods sold. Now you see the term net sales. We're going to get to that today, or maybe on Friday, what we mean by net sales as well. All right, so that's your income statement. Again, if you have any questions, please ask. So gross profit. All right. Now, that just happens to be the income statement. There are balance sheet differences as well. The key difference on the balance sheet is the fact that the significant, or one of the more significant items in the current asset section is going to be merchandise inventory. So when you look at a balance sheet for a merchandising company, it is going to be significantly different in a couple of ways. One, you would expect that their payables would be quite large because they're buying significant amounts of inventory. And we typically think of accounts payable as going to be related to the the inventory purchase. So accounts payable are typically tied to the purchase. But right now, on this part of the balance sheet, on the asset side of the balance sheet, merchandise inventory is one of the key current assets. Merchandise inventory represents the inventory that they're holding, they purchase from outsiders. Notice in the blue, it tells you there's no raw materials or work in process. Next semester, when you deal with a manufacturing company, they not only have merchandise inventory or finished goods inventory, they also have to buy materials that go into the process, as well as partially completed inventory. So if you're manufacturing your own product, so in an Apple factory, when they're manufacturing an iPhone, they have materials, they have parts, that's one inventory. When the inventory is in process and not finished, it's called work in process inventory. It's partially completed. And then, of course, the finished goods inventory is going to be the merchandise inventory. So those would be the balance sheet items, or the key balance sheet items for a financial service company. All right. So, for a merchandising company versus a financial service company. So for a service company that we've seen so far, they have service revenue, no cost of goods sold, and they would not have a merchandise inventory. For the merchandising company, you've got sales revenue and, of course, the merchandise inventory. And more importantly, on the income statement, you've got the cost of goods sold along with the gross profit margin. Okay. Now, we're not going to do any questions here because these are out of place. So now let's go into the second learning objective, and that is going to help us understand how to account for inventory on what is known as a perpetual inventory system. There are two ways, and this is, when you think about inventory, you have to think about the components of inventory. So what are the components? The components are the cost per unit as well as the units that are on hand. So when you think about inventory, what happened here? Just go on. Right, give me a second. Let me get this on. Okay. There it is. Okay. So when you're thinking about the inventory, you have to think about the quantities. These are the units. And then the unit cost. When we look at the units, there are two ways that we can account for those units. So we're focusing right now on the quantities or the units that are in inventory. So the two systems that we can use are something known as a periodic system or a perpetual system. When you look at a periodic system is somewhat unrealistic. You would have purchases being accumulated in a separate account. You would then add those to the amount of inventory that you've already had on hand, your beginning inventory. And then at the end of the year, you physically count the inventory. The physical count of the inventory is done in order to validate the amount. But the problem is with a periodic inventory system, you only do this at the end of the period. So to repeat, what you would be doing is counting inventory at the end of a period to determine its balance. That is not a very good way to manage a company unless you have a very small company or a company that doesn't have optical scanning or a better way to keep track of inventory. If you have to wait till the end of the period to count the inventory, you're going to be going through each day, not necessarily knowing the exact amount of inventory you have on hand. So the periodic inventory system is somewhat impractical, and it could be used for the smaller companies or companies that don't have optical scanning devices. So what will happen is that, anyone work retail? All right, did you ever do a physical inventory where you had to count inventory? Right? Yeah. All right. So that's what we're talking about here. Now, you would have to take a physical inventory, actually count them, record the amounts. In some companies, you could take inventories using optical scanners. You could just zip the products. In other cases, you have to count them physically. So when you look at the cost of goods sold, here, in a periodic inventory system, you would take the beginning inventory from your opening balance sheet. You would add to that the cost of goods that are purchased, and then that would give you something known as goods available for sale. Now, you have to remember, throughout the month, you don't really know what's there until you count it. Now, again, this is not a very practical way to manage, but in a pure periodic system, you don't have any information with respect to the inventory until you count it. Then you go out and take a physical count, and you determine, in this case, and these numbers are just given to you, you determine that 6,200 were available, you counted 4,100, and therefore the amount of units that you sold were 21. Now, of course, that excludes spoilage, theft, damage, so you assume if it's not there, it's going to be sold. So if you look at this example, what we're really saying to you, when we talk about unit costs or coming up with the dollar amount, what you really have to do is, if you take the beginning inventory, let me just draw this out a little differently, and you add to that the purchases, and in this case the numbers are 5,000, and this is 12. The goods available are 62. Now, what you're not seeing at this point is how we split this up, because the amount available could only be in two places. It can either be sold or in inventory, one of two places or both. So either you sold all that inventory, or you still have some left, or you have all of it left. So what we have to determine is how much of that cost is going to go to ending inventory. And how much of that goes to cost of goods sold. And it's almost like a scale. So what goes into this goods available has to equal what comes out of it. So in this case, if we counted 4,100, then 2,100 has to be in cost of goods sold. So the 62 minus the 41 gives us the cost of goods sold. So it's like a scale. It balances. What comes into the system, what comes into goods available, has to go out. And that is going to be in a pure periodic system. Now, we know that this is somewhat impractical. We'll talk about that next. A pure periodic system is going to be impractical because you have to be able to manage your business on a day-to-day basis. You really can't wait until the end of the period, whether it's a month or a week or a year. You can't wait to the end of the period in order to determine your ending inventory and cost of goods sold. And of course, you have to wait until the end of the period also to get gross profit. Oh, I'm sorry. Good. And then I'll get to it. And I'll repeat the question. Yes.
Okay. Could you do like a periodic system and have it like every 2 weeks instead of at the end of like?
Yeah, it depends. When we mean periodic, the question is, could it be every 2 weeks? Could it be every week? Yeah, I worked retail when I was going to college, and yeah, we used to take an inventory every Friday. And you could do it weekly, you could do it monthly or annually, quarterly, so it doesn't have to be at the end of the year. The period is what defines, or at least the period will be defined first, and that's when you take your physical count. Is that the same question? Yeah. Okay. Yeah, so it could be a weekly inventory, monthly, quarterly, whenever you need to get that information. Now, as I said, the pure periodic system is quite impractical because you really can't wait until the end of the period to come up with this information, because you need to manage your inventory on a day-to-day basis. We'll find out later in the next chapter that the periodic inventory system is going to help us quite a bit understand the inventory valuation and how to allocate the cost of the inventory to the units that you have on hand. So you really, by summary, really need to have a relatively small business in order to use the system, or inexpensive inventory. We're also going to use it, we could use it for larger companies too, for testing, for analytical purposes as well. Now, in reality, companies will use, and this is going to be our focus, companies will use perpetual inventory systems. Perpetual inventory systems are linked to technology, they're linked to inventory management, they're linked to supply chain management of companies. You're going to find that most large companies would operate in the following way. When you have a perpetual inventory system, inventory is continuously monitored. As soon as you buy inventory, it's added to the balance. When you sell inventory, it comes out. You can calculate sales, you can calculate cost of goods sold and gross profit. So under a perpetual inventory system, you have continuous monitoring of the inventory balance. You can have a balance available to you at any time. Now I'm sure if you work in retail, you know that you can go to your register, and as I said, you can calculate the gross profit at any time. You know that if you work in retail, if you go out to the selling floor, you know that you can go on a computer, and now a lot of people have iPads as sales professionals or sales reps. You go out to the floor, you go right on, they'll tell you, yeah, we have this in stock or we don't have it in the warehouse. They can find out where it's located, they can find out if it's back ordered, they can determine whether or not it is still available. So that information is readily available to the sales representative. If the information is correct, that you have units on hand, you sell the unit, you can go onto the cash register, you process the information, and you can deduct the inventory from your stock. It comes out, the next person that comes in would not be able to buy that unit. So it continually monitors the inventory balance. It allows you to have a cost of goods sold after each sale in real time, and gross profits can be calculated. And of course, summary here is that as soon as it comes into the receiving dock, it's scanned, and of course, goes into the inventory system, and when it's sold, it immediately leaves the system along with the cost of goods sold calculation. So the differences now between periodic and perpetual. Periodic inventory only gives you the information at discrete points in time, whatever that may be. Perpetual gives you the information on a continuous basis. Now, question. Where you work, someone that worked in retail, do you think you're using periodic or perpetual? Perpetual. Why do you still take a physical count? Yeah, you're looking for validation. So even though you have a perpetual inventory, you still have to test count it to make sure that the perpetual records are valid or they're correct. Now, you could do this in one day. You could do this once a year. You could do this every day. Some of my clients used to count inventory every single day. They would do one section, so they would tell, and I would have some auditors go out and I would say, on your way to work today, stop in this warehouse, go to the third floor and watch them count this particular shelf. They'd count the shelf, come back with the number, and we'd go on the computer, and yes, they had computers when I was working. You go back to the computer and you test the amount. If they counted 15 units and there's supposed to be 20, then we know that there's either theft or pilferage or damage, or maybe the records are inaccurate. So whether you have periodic or perpetual, you still need to have a physical count. There's a question. Yeah, Joe.
Yes, basically was remodeled, and what they did was they audit every day, but when shipment comes in, they tag it up, and they use what is called the WAN system. And as you said, every day they audit a section
Right.
with the WAN
Right.
to make sure that,
And that's like something that scans?
yes, it's scanned and it goes directly to the CRM system.
Right. Right. So you're talking about a system where every day a certain section of the warehouse or a certain section of the store is scanned, goes into the computer, and you're checking for accuracy or inaccuracy. Yeah. Question?
You're taking like a physical inventory and it's just someone discounted as you said, it's still considered like
Okay, so you're saying if you're taking a physical inventory and there's a miscount? Okay. What could happen is if the amount is extremely significant, you go back and recount the section. And to validate, if you count it again and the inventory is not there, then you assume it's either an error in the system, or if it's systematic, if it happens every week, then you might suspect theft. And you'd have to, make sure that you alert security or the individuals that are responsible for tracking down the items. Right, so, yeah, and the other thing too is that the CPA firms or the auditors will observe some of the procedures that you have. So you could do your own physical counts, but then we have a CPA firm to observe that as well. Okay, now what we're going to do is we're going to take a look, and I'm going to put this up on the screen. We're going to start looking at some of the documents that are involved with purchasing. Let me see if this helps. This way I can re-zoom in on it. All right, so first, this is an example of a purchase invoice. This is where the purchasing system starts. All right, let's take a look at the invoice. So pretty simple. Again, I'm just going to comment on a couple of things. You have your Southwest Electronics, that's the seller. Smart Touch Learning is going to be the buyer of the inventory. If you look on the date of the invoice, there's an invoice number, and that's the invoice date. Here, which is going to be real important for us, is going to be, let me move this in a little bit, these are the credit terms. These are the credit terms. I'm going to say this again, but the credit terms tell you whether or not you can get a discount. 315 net 30 means that you get a 3% discount if you pay within 15 days. If you don't pay within 15 days, the balance is due within 30 days. This is done by a lot of companies. There are other combinations. You could have 210 net 30. 210 net 30, 2% discount, you pay me within 10 days. If not, the balance is due at the end of the month. Why do companies do this, by the way? Yeah, well, we want to get, the electronics company wants their money faster, and they can use it. So the faster you pay me back, I can use that money for other inventory purchases, or I can use it in my operations. So we're trying to speed up. Going back, and again, I have to say that make sure you take some notes, and I notice when we go over the exam tomorrow, there were lots of things that I mentioned, and even if I'm not writing it down, it's still important, and I'm trying not to just read. I made these slides really detailed because of the size of the class, but I am adding a lot to it, so make sure you follow exactly what I'm saying, and here's an example of a question that relates back to that operating cycle. Remember what we're trying to do. We're trying to speed up the collection, because remember, the merchandiser's cycle is cash is being invested. Let's forget about the accounts payable. I'm putting cash into this business to buy inventory. Now my money's sunk into that inventory. If I don't sell it, I have a drain on cash. Let's say I sell it, I have another trap or another problem if I don't collect. So I need incentive to collect, and that incentive is to give someone a discount to get that money faster. This way, I can keep the cash flowing and keep the cycle moving. Don't forget, if I don't get paid or if I don't collect quickly enough, what am I going to do for the next part of the cycle? I'm going to have to borrow. And companies have lines of credit, and those, just like us, take your credit card. I don't know what, maybe, at your age, you may have a $500 line of credit on your credit card. That means that if you ever need money, you could borrow. Companies have lines of credit like that too. So if I can't collect my receivables, I can't sell my inventory first, but if I can't collect my receivables and I have to pay off the accounts payable, so if Smart Touch has to pay off the electronics company and they can't collect, they've got to obviously take out a loan or at least draw on a line of credit to make that cash come, or at least to pay off those bills and to keep the cycle flowing. So the credit terms will allow you to collect cash more quickly. The other issue is, of course, the unit price. We talked about the units and the unit cost. That's going to be important next chapter. How do we know what units, when we ultimately sell this, what's the cost of goods sold? This is going to become our cost of goods sold. Now, Smart Touch is not going to sell this for $350. They're going to probably sell it for $500. So they're going to mark this up. There's going to be a profit on that, and that's going to be their profit margin. But this is going to be their cost. If I sell one unit for $500, $350 is my cost of goods sold. $350 is going to be the cost of goods sold. Now, the invoice was paid on the 15th, which means that they did get their discount. And in fact, you could see here that the amount that they paid was only $33,000, so it was net of the discount. They paid within the discount period, and they were able to get the discount. Okay? So this is the starting point, the sales invoice, or the purchase invoice, where you have to determine all the terms of sale. One thing we don't see here is tax, which we'll talk about later on, and the shipping. So the freight, in this case, would be part of the inventory if it's paid, but the freight is not here. You might be paying a separate shipping company. So the freight is not included on this particular invoice. Okay. Now, let's take a look at how we would account for this particular acquisition. And we're doing this, let's say it's a cash purchase. If it's a cash purchase, you would just debit merchandise inventory, credit cash for $35,000. Merchandise inventory is an asset. Of course, it goes up by a debit. So it's got the same characteristics of any other asset. And of course, cash is credited for that amount. On a purchase on credit, you debit merchandise inventory, credit accounts payable. As I said before, for a merchandising company, I would expect merchandise inventory to be a significant amount on the balance sheet. Current asset and accounts payable should be very large as well. We typically think of accounts payable as being associated with inventory. Now, that's what your T account looks like. And let me just keep track of this. What I want to do is I want to set up these accounts separately. And I think what we want to do also, I'll move that down a little bit. Okay. It's going to abbreviate merchandise inventory. And that's on June 3rd, and that's $35,000. Now, what you're not seeing here, which I think you should add, is going to be accounts payable. And that's also on June 3rd. Okay, so I just want to go back and forth between the journal and the ledger. And these are the ledger accounts. All right, so any questions on the transaction to purchase inventory? Okay, I think it's pretty straightforward. We'll come back to this. I would just keep track of the T accounts. And the reason why we want to do that, I'm just going to give you the rationale behind it, is because I need to know if there are any returns, any merchandise returns, how much do I owe, do I take the discount or not? So I need to know what the balance of accounts payable is at any point in time when I pay, especially when at the point of payment. All right, so if there are no questions there, let's now talk about the shipping or the freight cost. And with respect to the shipping or the freight cost, it really depends on a couple of things. Number one, is it freight paid to buy inventory? Is it freight or shipping paid when you sell? The other issue is the terms of shipment. There is something known as free on board, and these terms are important. The terms will tell you who pays the freight and who is legally responsible for the inventory, who has legal title to the inventory. Now, we have, and I'm going to show you this on the diagram in a second. FOB shipping point means that as soon as the goods are turned over to the trucking company, so if this is the receipt, the shipping dock, as soon as I put the goods on the truck, they're yours. You're the buyer, you have them, you pay the freight, and you're responsible for any damage or following up with the shipping company. If it's FOB destination, I would put it on the truck, but I don't give up title. I still own the inventory. I'm still responsible until it reaches your destination, and I would pay the freight. So in this case, the seller would pay the freight. So if we look at the illustration, which I'll put up on the screen, which again I think is easier just in case you don't have this. When we look at the first one, which I've highlighted, when it's FOB shipping point, the seller puts the goods on the truck. The buyer is responsible for paying the shipping, and legal title passes to the buyer at this point. Risk of loss now belongs to the buyer. If it's FOB destination, the seller will pay the freight. The seller is legally responsible. It still has title. Title doesn't pass until the shipment reaches the buyer's location. So in this case, it is the risk of loss remains with the seller. So when you do these problems, and again, these are these little nuances, little things that you just don't pick up or you don't maybe write down, and then when you do the exam, multiple choice question, you miss something like this. So again, make sure you know, when you look at shipping, make sure you know what the terms of shipping are and who's responsible for the freight. Now, when the buyer is responsible for the freight, so let's go back and assume it's an FOB shipping point, this becomes part of the inventory cost. So when the buyer pays the freight, this becomes part of inventory in a perpetual inventory system. Yeah, Joe?
An example where the buyer would be the seller, the buyer would be responsible, the seller would be responsible.
Well, the buyer here, in this case, if it's FOB shipping point, as soon as I step off or as soon as I hand the goods over to FedEx or I hand the goods over to UPS or a trucking company, that means that the buyer owns the good. Title passed at that point, and I'm no longer responsible as the seller. And you have to pay the freight as the buyer. If it's FOB destination, that means that even though I put the goods on the truck, title didn't pass, I still own that inventory. The seller still owns it. The seller's responsible for the shipping charges.
So something's shipped internationally, it would be a FOB.
Probably destination. Yeah, probably would be. Now, the interesting thing, I know you talked about what your company does. A very interesting thing is that comes up in auditing is, what do you do if you're an auditor and you don't find the goods in the warehouse? Do you assume they're sold? Not necessarily. You have to know the terms of sale. So if the goods are in transit, my client may still own that inventory. So if I'm auditing, or your company's my client, and I go in to observe your inventory, and I don't see the items there because they're on a truck someplace, do I assume that it's a sale? And don't think companies don't do this. Some of the more, I guess, popular or famous or infamous accounting irregularities came from companies who just shipped inventory, just kept shipping, auditors didn't find it, and unless you check the documents, you would assume they're sold. So you have to examine the documents in order to determine who owns the inventory. So if it's an FOB destination, the seller still owns the goods. So even though the goods could be on an ocean freight, they could be in the middle of the Atlantic Ocean, even though I can't physically count them, from the documents, they're still in my inventory as the seller. Yeah, Matt?
Basically, the goal for the buyer is for it to be FOB destination, and the goal for the seller is to be
Shipping point, yeah. If you could do that, but again, it's going to depend on the business relationship and your competitors, correct?
what determines that?
It's going to be, okay, the question is, what's going to determine the terms of, or the shipping terms? I would say the type of goods. I would think the more expensive the items and the longer the distance, the more risk. And if, as a seller, you probably don't want to take that risk, so you'd probably have an FOB shipping point. The buyer, again, may have more leverage. So let's say you're, a company like Walmart that has lots and lots and lots of power over these companies, you might get better shipping terms. And it depends on the economy. Because don't forget, right now, everyone buys online, correct? Do you always get free shipping? No, sometimes you do, and it depends on the product. So if the company has a lot of overstock and they want to get rid of it, they'll give you free shipping. Or if they want you to spend more money, they'll give you free shipping. So a lot of factors there. I'll get over there. Yeah, another question.
Which different companies that have like proprietary distribution centers?
I mean, they have their own distribution.
Like regional distribution?
Right. So if you have your own distribution or regional distribution, you could do the same thing. You could set up the shipping terms the same way. You could charge or have it free. Insurance? Yeah, the insurance cost is probably going to be picked up by the seller unless it's a very valuable item, and you may ask it depends. If it's FOB destination, the seller has to insure the goods because they have the risk of loss. If it's FOB shipping point, you own it, you just bought it, as soon as I put it on the truck, you're responsible and you may have to insure it. All right, good questions. Any other questions? Okay, now, when we look at the accounting for this, when you look at the accounting is going to tell us that when the freight is paid, as the seller pays the freight, which is going to be the FOB destination, it's an expense. When the buyer pays the freight, it's freight in and gets added to the inventory. So you would debit the inventory directly. So let's take a look at what the journal entry would look like here. In this case, I'm assuming that SmartTouch pays $60 to an outside shipping company. They debit the merchandise inventory and they credit cash for $60. Now that means at this point, and this is a perpetual system. Now some of you may have had inventory accounting covered in high school courses, and sometimes they might use a periodic system, and they might have an account called freight in. It's a separate account. In a perpetual system, it goes directly in the inventory. So the freight goes in the inventory account, and there's no change in the accounts payable. So let me go back here and tell you again on 6.3, we now have a $60 increase in the cost of inventory. Now what I want you to carefully take into consideration is that accounts payable did not change in this case. You're not paying the seller for that shipping. Regular cash account. Yeah, I'm just not showing you the cash account there, but the regular cash account would be credited. So the question is, would the regular cash account be credited? Yes. Okay. I'm sorry, oh, yes. Yeah, the other side of that goes to cash. I'm just not showing that here. All right. Now, again, the reason why I want to keep track of the inventory and especially the accounts payable is because of the next topic. Next topic is returns and allowances, and this is where it might get a little tricky. Purchase returns and allowances are actually accounted for in the same way. Purchase returns and allowances will reduce inventory and will also reduce your accounts payable. But what I want to make sure is you understand the difference. A return means that the goods are physically returned back to the seller. An allowance is where you get a credit. Literally, you get money back in a sense where you don't have to pay as much because something happens. This happens all the time. You buy a refrigerator from Sears or Best Buy. There's a scratch on the side. And you know what? It's going to be hidden anyway. I'll keep the refrigerator. You take a picture, you send it to the salesperson knocks off a couple of bucks, and that's an allowance. So a sales allowance would be for a slight damage, something you want to keep. A return is where you don't want it, it's just not meeting your specifications, and you send it back. Yeah, question? Yeah, okay, so a return is where you get the item delivered. It doesn't meet specification or it's damaged. You send it back to the seller. You actually return the amount. So just think of, you're buying an iPhone, bring it home, try to set it up, you realize it fails. It doesn't boot up anymore. You got to bring it back to Verizon or any of the wireless carriers. If, however, you take the iPhone home and there's a scratch on the screen, so you know what, it's still working, go to Verizon, they give you $100 off. That's an allowance. You still keep it. So on the allowance, you still keep the product. Now, the purchase return and allowance is, as I said, it's accounted for the same way under a perpetual inventory system, and it's going to reduce both the inventory and the accounts payable. So in this case, we assume that Smart Touch returned $7,000 worth of inventory. They debit accounts payable and they credit the merchandise inventory account. So they did that on June 4th. And of course, the T account will look like this. So the merchandise inventory has a balance of $28.60. Now, here's the return, and that's on June 4th. And also on June 4th, what you're not seeing in the PowerPoint is that you now owe $28,000. So you now owe $28,000. So you've got to keep track of the accounts payable, because now if I told you there was a discount, if you paid within the discount period, the discount is on $28,000, it's not on $35,000. So you have to keep track of the transactions. So transactions, so far, you purchased inventory, you had freight, and you have a sales return. Now, a sales allowance would be accounted for exactly the same way. The sales allowance would be accounted for in exactly the same way. There's no difference. Yeah, Matt?
What happens if there's a cost to ship it back?
All right, if there's a cost to ship it back, it depends on if it's separate. If there's a, let's say, $100 shipping on this, then we would probably net that out to $6,900. If you have to pay somebody else, it would go into regular operating expenses. Because if you're paying it to someone else, it doesn't affect that vendor's accounts payable. Right. Yes?
Why is shipping cost not expensive? Why is it?
Oh, because, okay. It's a real good question. All right. And remember, when we were looking at the introduction, and we said we need to worry about units and the unit cost of inventory. The unit cost of inventory is really made up of more than just one element. So when you look at unit cost, and I'll move this over in a second, and this is, oops, let me get out of the way, okay. Just give me a second. When we look at this from, we'll see this a little bit more in the next chapter. How do you get the unit cost? Unit cost should be the invoice price plus all reasonable and necessary expenditures that you have to incur to get the inventory in your location and ready for its use. So one of them would be freight or shipping. So an example here would be a shipping cost. The other one would be packaging. If you have to, package it differently. Now, it's my understanding, I never worked for Verizon or T-Mobile or any of these other wireless carriers, but it's my understanding that when Apple sells the product to one of these wireless carriers, they have to package them up again somehow, right? They got to put them into a Verizon box and all that. Apple doesn't throw them in a Verizon box, right? They have to do it, right? So all that packaging cost would go to the cost of inventory. So packaging, freight, some things you don't include. What you wouldn't include is inefficiencies like waste or abnormal spoilage. That would be something that's inefficient. You can only call an asset something that's what? It's an economic resource with future benefit. So you can get your money back for the packaging and shipping, but you can't get your money back for any kind of inefficiency or waste or, for example, what if you had a small store and you overbought inventory and you had to store it someplace else and you had to pay rent on a small store or a small space just to store inventory temporarily? That's inefficiency. And you can't add that there, you'd have to expense that. That's a good question. So when we get to the second piece of this, right now we're talking more about units. We're not discussing the unit cost, but the unit cost issue is invoice price plus whatever is considered to be reasonable and necessary to have the inventory in place and ready for sale. Whatever you need to do to get that inventory ready for sale is considered part of the cost of the asset. Okay. All right, any other questions so far on the inventory and the return, purchase, the freight, and the return? Yes? I got to come down there, so yeah.
So who will be for that $7,000? The shipping company or the...
Oh, the 7,000? Well, what happens is you don't really have any. Let me bring that back up again. All right. So you don't really have any. There's no cash exchanging hands here. You basically just return the inventory. Now, the question who pays for the shipping or who pays for the actual. Yeah, I mean, that could be where if you have a return and they tell you to put it go to a UPS store and pay it, that would be like an expense on your part, like a shipping expense. It depends. If the seller is willing to pick up the cost, then it's an expense on their end. It's not going to affect the inventory here unless they deduct it. So they'll say, we'll give you a credit minus the shipping cost. So it's going to depend on how it's structured. All right. Now, at this point, we're going to think about whether or not we're going to pay the invoice within the discount period. So, going back to the terms of sale, the invoice has the term of sale. So again, going back to the purchase of the 100 tablets that were purchased by our sample company, the tablets were purchased and the terms of payment were $315 net $30. So again, the discount is 3%, the discount period is 15 days, and the total credit period is 30 days. And what this means, again, if you pay me within 15 days, I give you 3% off of the invoice price or the balance of the liability or the accounts payable, and if not, you have to pay the full amount within 30 days. Now, the discount is only accounted for when the invoice is paid. If you don't take and I'll talk to you about this in a second, but if you don't take the discount, it's just not going to show up. So let's do a case where you take the discount. Now remember, the reason why I'm keeping track of accounts payable here is because I need to know what I owe on the date that this accounts payable is paid. So by discount law. So I don't owe you 35 anymore, I'm returning 7,000 worth of goods, so only owe you 28. So now that I owe you 28, the discount is 840. And the discount is only on the balance of the payable, does not include any of the freight charges, particularly even if you paid the freight to the carrier or to the seller. So the entry in this case would be to debit the accounts payable for the full amount. I want you to pay careful attention to this because even though you're paying them net of the discount, you're only going to give them $27,160, the amount of accounts payable is fully paid. The discount also reduces the cost. That's the other important point. The discount reduces the cost of the inventory so that the cash paid is $27,160. The inventory cost is reduced by $840, and the balance, or I should say the total, is going to reduce the accounts payable. So the amount that you now find on your financial statements would be the following. You would have in here, and we paid this on, let me just check the date, we paid on 6/15. Yeah, we paid it on time, we paid it on 6/15. So we paid this on 6/15, put that right there, 840 comes off. So the ending balance of inventory is 27,220, and on 6/15 we paid off the liability. So the ending balance of inventory, and you'll see this later, is 27,220. Yeah.
How come you didn't take the 3% off the 35,000 in the beginning?
Because you didn't pay it. The 3% only you could. Now, there are some methods that tell you to take the discount off first, and then if you don't take it, you penalize the company for it. But the method we're using, you can only take the discount off when you pay it.
I thought it was paid here. I thought cash was paid.
Oh, that example was before any returns. On the example earlier, assume no returns. Right? So if we go back, let me get to this question. This is a real good question. So does not anticipate the return. So the return is not, when you first get the invoice, there's no return anticipated. So they don't think you're going to return anything. So that's why this shows up. This is just telling you that if you pay me on this date, that's what you'd owe. If you wait, you'd owe me $35,000. So that's a good question, just to make sure we clarify. One other, I have a question for you. What would be the journal entry if the discount is not taken? Can anyone give me the journal entry if they don't take the discount? So let's say on July 1, what entry would you make? Yeah. Right, for how much though? 28, right. So if you don't take the discount, you would still debit accounts payable. So you still debit accounts payable for 28, and you credit cash for 28. So that's if. Didn't happen here, but if the discount is not taken. All right, any questions on that? Any other questions? Let me ask you a couple of questions in a second. By the way, you've got last slide with the balance. Okay, so that's the merchandise inventory that goes on the balance sheet. All right, so let's get a couple of questions and just 2 or 3 quick questions. So the first one, again, this should be, got the channel up there this time. I think we got it straight. So, all right, what I want to know is credit terms of a merchandising company are 115 net 30. This means that a buyer can receive a discount, 1%, if the invoice is paid within 40 days of the invoice. So again, this should be pretty simple, but just want to be sure. Better get this one right. Everybody gets this one right. All right, so good. As suspected, almost everyone got it right. So again, problem with A is, well, first of all, it's false because you only get the discount if you pay it within 15 days. So if you're part of that 2%, make sure you know how to read the terms of sale as well. Okay, now the next one is, I'm going to give you this one. If purchase returns allowances are granted, you don't have to return, if the purchase allowance is granted, you don't have to return the merchandise. And that's true. We were explaining that before, right? One of the questions I had earlier, the allowance is simply going to reduce the amount of inventory and the amount that you pay. All right, so let's see if you can do this one. Company uses perpetual inventory. They purchase inventory and later returned $200 worth of goods, which is the following is the correct journal entry. Typical exam question, you know? All right. Well, the answer is D. Debit accounts payable and credit merchandise inventory. All right, now, question. Would there be a difference if this was an allowance and not a return? No. Same thing for allowances. All right, of course, A is wrong because what are you doing in A? In A, let me show you why. I mean, you got enough people spread out here, so A is wrong because by crediting accounts payable, you increase it, and if you're returning something, I don't think you want to pay more money. Same thing here, purchase returns, it's not a separate account. And in this case, this is basically increasing inventory and increasing accounts payable. So those are wrong for those reasons. Okay? All right. Okay, so again, in C, if you pick C, a debit to inventory increases it. You just returned it, you're not going to increase inventory. And a credit to accounts payable increases it. And if you return something, again, you don't owe more. So D is the correct answer.
Wait, but if you credit merchandise inventory, doesn't that mean you lose inventory?
No, you're just changing the value. Okay, the question is, when you credit merchandise inventory, are you losing inventory? You're not losing physical units, you're changing the cost per unit. Or changing the value of the total inventory. So, this is a good question. Make sure, and that's why I put that on the screen earlier, we differentiate between quantities and costs. This is changing the cost of the inventory, but not the quantity. So again, if you have an allowance, if you have a return, yeah, you're changing both. So on an allowance, you change only the cost of inventory, not the quantity. If it's a return, you change both. Okay. All right. So that's the buy side or the purchase side of merchandising. Now we're going to go on the selling side. How does merchandising differ from a service company when we are dealing with sales? So we know, first of all, that the process will initiate with a sales invoice. And when you record a sale for a merchandising company, you need to think about two entries. Right now, this company sold 2 tablets, and their selling price was $500. That means that not only are we going to record sales, we're also going to have to record the cost of goods sold. So there's always going to be 2 entries. So one part of the sale entry is going to record the sales revenue as you did with a service company, where you're going to have a debit to accounts receivable and you'd have a credit to a sales revenue in this case. The problem here is the cost of goods sold. The cost of goods sold has to be recorded along with the reduction of inventory. So as you can see in summary on the next slide, the first entry records the sale. The second entry would record the inventory reduction and the cost of goods sold. So in a perpetual system, when you make these entries, you are able clearly to come up with the cost of goods sold, gross profit at that point in time. So the 2 entries you would make, if you sold this for cash and you sold 2 tablets at $500 each, you'd have a debit to cash and a credit to sales revenue for $1,000. Cost of goods sold is given at $700. Actually, you should note back from the purchase invoice that if you sell 2 of those items, how much was the purchase cost? The purchase cost was $350. So if I could put this back up for you, it is consistent that the purchase cost of that inventory is $350. So they sold 2 units at $350, so their cost of sales is going to be $700. So that's where they're getting that number from. So the cost of goods sold is 2 times the $350 or the $700. Now you could also sell on account, and we debit accounts receivable, credit sales for 10 tablets in this case. So we're changing the example. Yes, I'm sorry. Question, Tom?
What's the logic behind that factoring in the cost of freight and everything to per unit?
At that point, the question is the freight. Did we have any freight in there?
Or even
No.
tax?
Yeah, you would have. Yeah, you would have had tax. You would have had other factors on the invoice. Yes. Okay. Just oversimplifying it. right? Because that invoice, we'll get to sales taxes in another chapter, but there should be sales taxes on that as well. And there could be some delivery charges on that as well, which we'll get to. Okay, good question. So for now, we'll hold off on the sales tax, and we're going to hold off on the freight charges on delivery. Now, in this case, we have 10 tablets for $500, and the cost, again, is $350 each for 10 tablets. You debit accounts receivable, credit sales, debit cost of goods sold, and we credit the merchandise inventory. Now, just as we did in the purchase chapter, what I want to do is I want to track some of these numbers. So what I'll do is on the document camera, I'm going to build some T accounts for you. And this is a good way to look at this. You can look at 3 T accounts. We're going to have sales. We're going to have accounts receivable. And I'm going to have COGS. So, and this is for June 21st. So on 6/21, we have a sales. So we debit accounts receivable for $5,000, credit sales for $5,000, and also we have cost of goods sold of $3,500. Oh, yeah, I'm sorry. So you should have those accounts. I'm posting them to the ledger at this point as well. All right, now, any questions on the sale entry? So the sale entry will always involve 2 entries, or the sale transaction always involves 2 entries, the sale and the cost of goods sold. Now, when we talked about purchase returns, we noticed that purchase returns and allowances were accounted for in exactly the same way. You could, on your end now, be faced with a situation where a buyer wants to return goods to you or is asking you for an allowance. There is a big difference between the two. When we have a sales return, inventory is going to be returned, so you have to change your inventory numbers, but an allowance and cost of goods sold, but an allowance will not affect that. So when we now look at sales returns separately, we're going to treat them differently from sales allowances. There are 2 entries that we're going to be dealing with. Let me get the right screen up there, I'm sorry. So you have to make 2 entries. The first one, if you have a sales return, you have to reduce accounts receivable, and there's going to be a contra account called sales returns and allowances. The second entry is going to reduce the inventory and the cost of goods sold. Now, I want to go back, I'm going to get back to this idea of the contra account in a second. But sales returns and allowances is a contra revenue account, and it is used for a very particular reason. Question is, why not debit sale? I have a sales return, so somebody is returning something to me. Why not debit sales directly? Why do we debit a contra account? Yeah, exactly. You want to keep track of returns. Just a very good business reason. You want to keep track of returns. You probably could do that for purchases as well. You know, but it's not quite as important. So sales returns, you have to keep track of sales returns and allowances. That's why we use the contra account. Contra account is separate. So let's assume that a customer, if you look at this last piece here, customer returns 3 tablets that they originally sold for $1,500 with a cost of $1,050. So the entry is going to be a debit to sales returns and allowances. Sales returns and allowances is a contra revenue account. It's going to offset sales on the income statement, and you reduce your accounts receivable for the selling price, and now you have to reduce the cost of goods sold and put the item back in inventory. The item is now restocked, it's back in inventory. Now, the reason why you have 2 entries, unlike services, you're now dealing not only with a selling price, but you're dealing with a cost. So it's restocked, put back into inventory. Now, if you go to your Sorry about that. If you now go to the ledger, it would look something like this. So sales didn't change, but you're now going to have this contra account, sales returns and allowances. And this is contra revenue. So this is on June 25th. And rather than debiting sales directly, you debit the sales returns and allowance account. And that's for $1,500. In addition, accounts receivable is reduced. And accounts receivable has a balance now of $3,005. I'm not going to worry about the merchandise inventory, but cost of goods sold is now reduced to $24.50. So when you have a sale return, inventory has to be restocked. I'm just not showing you that here. Cost of goods sold is reduced. You reduce your accounts receivable, and the sales returns and allowance is a contra account. And again, rather than debiting sales directly, you would put this in a contra account, but it has the same effect. So when you debit sales returns and allowances, you are effectively debiting sales. Now that is where you return the goods so that it has to be restocked and cost of goods sold has to be adjusted. So this is for a sale return. Let me make sure that's clear so we differentiate the two. We have a return here in this case. And there's a return here. Okay, that's the cost. Now, an allowance is going to be different. If we go to the allowance now, a sale allowance does not have any restocking. There's only one entry. And the entry is only going to reduce the amount you owe. They credit your account, technically. So what will happen is if you call up Smart Touch and you tell them that the item came damaged or scratched slightly, there is a allowance of 100. You don't return the good, you notice that we're crediting, that's where the term comes from, they're crediting your account. They're going to credit the account. So we're going to debit the sales returns and allowances on June 28th, and we're going to credit the accounts receivable. Going back to the ledger accounts, you'll notice that accounts receivable is now going to be, well, sales returns and allowance, of course, is hit first. In this case, there's an allowance. And that account is now 1,006. And we're going to reduce accounts receivable for 100. So accounts receivable has a credit balance of, a debit balance rather, of 34. Sales returns and allowances has a debit balance of 16. Sales is a credit balance of 5, and cost of goods sold is 25, or 24.50. Yes, question. How much? Okay. All right, now, the reason why we have to keep track, and just hang in there for an additional 7, so I'm getting the official countdown. We have 7 minutes. So if you notice, you've got to keep track of the accounts receivable, once again, for sales discounts. Just like you took a purchase discount, you may be granting sales discounts. This example assumes that there's a 2% discount, so let's assume that this company paid within the discount period. The problem, and I was going to show you, I'm going to immediately go back to the DocCam. We have another contra revenue account called sales discounts. Now, what happens, they're assuming that it's a 2% discount. How do they get the 2% discount? In order for you to make sure that you have this correct, you would have had to have the correct amount of accounts receivable. So basically what I'm telling you is if you don't keep track of accounts receivable properly, the discount's going to be wrong. Okay? So in this case, the discount, I'll put it up here, the discount is going to be on the accounts receivable balance. That's the balance of accounts receivable times 2%, and you get the $68 allowance. So you're able to pay off the $3,400 of accounts receivable by only giving $3,332. So that when you go back to the entry, you'll see that we debit cash, which is the net amount, $3,332, debit sales discounts, which is a contra revenue, and then we credit accounts receivable. So that when we go back now to the, we now have another contra account, which is sales discounts. And this was on 6/30, paid within the discount period, it's 68, and then of course, you paid off the accounts receivable. So accounts receivable is fully paid off. Now, when you look, and again, this is another contra revenue. And once again, the contra revenue is designed to keep track of how many discounts people are taking, and the sales returns and allowances are contra revenue to determine how much of allowances or how many returns you're getting. Now, when you saw the term earlier, net sales, it is basically sales minus sales returns and allowances and sales discounts. So to wrap this up, when you look on the income statement, you have sales of, so on the income statement, you'd have sales of $5,000. Slow it down, please. You have sales returns and allowances of $1,600, and then you have sales discounts of $68. Sure, the right number. So that becomes the net sales figure. Then if you take the cost of goods sold from that amount, you get the gross profit. So if you wanted to get the gross profit, gross profit should be $882. Okay, so the term that we introduced earlier, net sales, what do we got? So the term we introduced earlier, net sales, is sales minus sales returns and allowances minus the sales discount. Okay. All right, now, okay, so hold down. So for Friday, again, tomorrow, for those of you that came in late, I'll review the exam here. If you come in, I'll give you back your Scantron. We went through, we graded all the Scantrons. I went through all of them, looked at all the erasures, and I circled all of them, made sure they're all clean. So whatever you got should be 100% correct. I'll go over all three exams tomorrow, free period, 2:30 to 3:50 in this room.